U.S. banks are shaking in their boots. Hey, everybody, you're watching Bull, Boom, Bear, Bust. My name is JJ. We're back with another dose of economic reality, and this one is an interesting one. The U.S. banks are shaking in their boots. Why? Because there's a proposal right now that would require any bank with more than 100 billion in assets to have capital requirements that are undoable for these banks. We're talking about a 20% capital requirement for some of these big banks. We're talking about Chase, Wells Fargo, Bank of America, all the big mega banks. And these banks will be crippled if that were to happen. So they can't allow that to happen. Here's a recent article here. This is how Bloomberg put it here just recently. Banks fight against capital rules. It's now at the center of a widening effort by Wall Street lobbyists to push back against the biggest overhaul of banks' capital requirements since the wave of regulations ushered in after the 2008 financial crisis. Remember, those regulations basically didn't do anything to stop another housing bubble from forming. I mean, look where we're at now with home prices and everything else with the cost of living. And remember, a lot of the cost of living that we're seeing right now is derived from bank lending. And why is that? Banks don't have to have any capital right now, zero. In 2020, it was an emergency reduction of the capital requirement to zero, also known as the reserve rate or ratio. So this could be a big, big problem for banks. Not only a big problem, some of these banks may not even survive this because they've loaned out so much money. Just look at the consumer debt now, over $17 trillion. Where does the debt come from? It's borrowed from some bank somewhere. So collectively, Americans are under $17 trillion in debt that wouldn't have been able to occur if banks had higher capital requirements. The higher the capital requirement or the reserve ratio, then the less money can get loaned out, and the cost of living would really be low. Asset prices would be low. We wouldn't have this housing bubble that we're in right now. Car prices wouldn't be as high as they were right now. This has everything to do with the cost of living, but yet we see the Fed out there just focused on the interest rate. So it's pretty ridiculous that that's where their focus is at, but this is why banks are shaking in their boots. Even Housing Wire is coming out against this. Of course, the real estate industry, anyone that loans out money, any industry, of course, the banks, they don't want this to happen. Housing Wire, bank capital requirements would put squeeze on mortgage market. So everywhere you look, there's lobbying and there's pushback against this requirement because the more money you can loan out, the more money you make because they're charging interest on money that you don't have if you're a bank. So you're making easy money. That's why you see CEOs like Jamie Dimon with net worths of billions of dollars. American banker, higher bank capital requirements would harm low-income borrowers the most. In other words, it'll be harder for people to borrow money, and who needs to borrow money and live off debt the most? That would be low-income borrowers. So of course, it's going to change people's lifestyle, but if the higher capital requirements prevent bubbles from forming and prevent the cost of living and prevent inflation from skyrocketing, then wouldn't it be better in the end? Well, the answer is yes. But of course, the bank's making all this money. They don't want that to happen, right? So it's pretty simple. I mean, they're making more money without capital requirements. They're going to make less money and they're going to be able to loan out less money and make less interest income with a lower loan volume. So, of course, the banks are going to fight against this. But not only that, it's even worse because what if the banks are so over leveraged that coming up with this reserve requirement, coming up with this 20% would be nearly impossible. Nearly impossible. We already see the banks, many of these banks are billions and billions of dollars underwater on their loan portfolios, especially now with the higher interest rates. And so much of the loans that were given out that these banks are holding on their books are at 2.5%, 3%, 3.5%, especially the mortgage market, right? So this is a big problem for banks. And therefore, I don't see this capital requirement being put in because I think it would instantly crash the economy. And of course, nobody wants that to happen. Nobody that's in a position of power, anyways, wants that to happen. Now, there's certain investors out there that want that to happen. There's people out there with cash waiting for a crash to occur. Also, if you had these capital requirements implemented, something else would change. The amount that you get paid from a bank for putting your money in the bank would have to go up a lot. Right now, 4% is actually pretty good. There's a recent story here. Banks offering over 4% on interest savings account. You also see CDs in the 4 or 5% range. And this would have to drastically increase to encourage people to put their money in the bank because, again, banks would then need the money deposited in their institution before they could loan it out if you have this capital requirement implemented. So you might see a 10%, 15, 20%, who knows, maybe even a 40 or 50% return on your cash if this were to be implemented. Another reason why I don't think that would happen. It sounds too good to be true. It probably is. So what I think they're going to do is they will continue with these zero reserve requirements because everybody knows, I think, that's making this decision or that's involved in this process or implementing this. I think they know that this economy is going to come crumbling down if this requirement were to be implemented. And of course, nobody wants that to happen on their watch. All right. So, what do you think about the odds of this happening? If you want to look it up, there's several articles out there. Just type in capital requirements banks, and you'll get all kinds of search results here. Reuters here put it like this: U.S. banking regulators extend feedback window for contentious capital proposal. So they know this is serious, contentious. Banks are fighting against it. Banks are shaking in their boots. And also think about what would happen if we had sound money. If the money had to be backed by a commodity, and I'm talking about a one-to-one ratio, such as an amount of silver or gold to the dollar, for example, that would also cripple the amount of money banks could loan out, and that would again make the cost of living come crashing down. The bubbles would burst. The home prices would come down drastically. Car prices would crash, and just the cost of living in general would plummet because the more money people can borrow, then the higher prices get bid up, and the harder it is for banks to loan out money, then less money out being spent in the economy, prices come down. You would see a drastic transformation in the economy, a lot of job losses, and a lot of different things would change because of this. But job losses aren't always bad, right? Some people think, oh, we can't have any job losses. We need to do whatever we do. We need to do whatever we can to prevent job losses. That means endless bank bailouts and no capital requirements because we don't want job losses. Well, think about this. Job losses aren't always bad. Imagine if they came out with technology in vehicles to prevent vehicles from having crashes or accidents. Imagine if that would happen. That would be probably too good to be true. But imagine if it happened. Just for my analogy here, you would see a lot, probably all of the car repair facilities, the body shops. You would see all of them closed down. There would be no cars to fix, right? Unless you have vandalism, weather damage, stuff like that. So you still have some. But you see my point. If we found a way to make vehicles so safe where there was no more accidents, you would have a lot of job losses with people working at these body shops because so many less vehicle repairs and damage repairs would be needed. You see what I'm saying here? So just because there's job losses doesn't mean the reason behind it is bad. Sometimes things need to be corrected that lead to job losses because some jobs are only there right now or only in existence because of the monetary policy that we have right now with all this easy money. And again, this easy money led to $17 trillion in debt. And you can take it all the way up to the national debt, $33 trillion, $100+ trillion in unfunded liabilities, all borrowed money created out of nothing. Right? So this is the problem. The banks don't want the capital requirements. What's going to happen? You let me know. Is it going to be maybe a middle ground, maybe a 10% capital requirement, or is it going to stay at zero? I think it's going to stay at zero because it would crash the markets and crash, it would burst these bubbles if this were to be implemented. And this would make the economy look bad, even though ultimately it would be a good thing because it would bring the cost of living down. But see, 99% of the people, I'd say 99.9% of the people don't understand how this all works like you and I do here, you, my audience. So then the people in power would get the blame for the crashing economy because people, again, don't know the reason behind it. They don't know this is actually a good thing in the end. They would just see what's happening in the moment. They would see prices falling. jobs being lost, and therefore there would be all this backlash against these lawmakers, against these leaders, against the regulators, everybody, right? So therefore, I don't think it's going to happen. Again, if it sounds too good to be true, it probably is. That's my opinion. What do you think about this? And what do you think the odds are of this happening to the banks? Thanks everybody for watching this. Keep stacking, everybody. Until next time. Bye for now.